good to be here. I'm particularly excited about this panel because I feel like I can learn a lot from these three individuals here I have with me. And, it's always good talking about alternatives to venture capital. And I feel like VC fundraising right now is about as cold as this room. So it's never been more important. But I think the way we're going to structure a panel today is I want to give a little bit of a baseline on venture capital and what it is. And then the three of the individuals up here have a unique expertise in three different alternative fundraising areas. So I'd love to kind of dig into those as well, kind of sequentially. But just out of curiosity, does anyone in this room know what percentage of startups actually raise venture capital? Any guesses? 42? That's 42 people. 42 people would actually probably be closer than 42%. So the number is actually 0.05%. And it's a big misconception because the wide majority of publications cover VC funds. Unicorns are no longer a mystical creature, right? In Silicon Valley, especially here at Draper University. So I'd love to kind of start this panel by asking, what is venture capital? What kind of companies is VC actually applicable to? And what are some misconceptions about venture capital? Just to start us off. Ben, I'd love for you to start this one off.
I'd love to start. Fund returners. I think that's the answer to what companies fit venture capital. It is a company that can return my entire fund as a venture investor, because that is how the venture model works. I have to be able to take those really big swings. I'm going to miss a lot of the time. When I hit the ball, it has to go really far. So if your company doesn't have that potential to be a $10 billion company, which almost no company can do, and maybe even shouldn't do, then you might not be a fit for venture capital along every step of your journey. There are right times and wrong times to insert venture capital into your journey as a founder. So I would say talk about what's the right company, fund returners. What was the second part of the question?
Misconception.
Misconception. I guess it's that you only can go VC. So if you are a company that can be a $10 billion company, you don't want to necessarily start with venture capital because it means you're going to be in a highly dilutive capital raising structure from day one. You start with an SBIR grant. You might want to start with something like crowdfunding, especially if you're a CPG company. You can start with zero, and your customers can fund that first run of your product line. And then you can get into different forms of venture capital that can be less dilutive, or different forms of capital that can be less dilutive, looking at revenue-based financing, and it's a very, very long list. And sometimes you might get to that place where you might be ready for VC, but it doesn't have to be the first step. It's not the only step.
I'd love to hear from Leonard on this one as well, because I know you guys sometimes are the first check and you work with a lot of VCs. So you see that dichotomy as well. There's a button on the side there.
Yeah. Can you guys hear me? Okay. Let's see. So I love what Ben said about returns. So has anyone heard of power law? I don't know. Okay. There's this phenomenon prevalent within venture capital that call it 10% of the companies that we invest in return 90% of the funds for that fund. So you guys don't need to know this, but I always sort of teach our founders a little bit of this venture math because it's helpful to understand the concept and what the scale is that we're looking at. So I just talked to a friend at Sequoia. They won't look at an idea if it's not even capable of getting to $100 billion idea. 100 billion, right? That, like, think about that. That's pretty hard. And so you have to have that vision to get to that scale. And so a lot of companies that come to us, and we've had even in the past couple of months, thousands of companies apply to our accelerator. We're only going to accept out of that 10. So it's less than the 0.05 or 0.5, however you look at it. In that sense, it's really difficult. And I always want to sort of push founders to think even bigger. How can this be even larger? How can we capture even a larger pie of what you're doing? Like, how's this going to change the world? And so that's really always my focus. So I love working with founders, and we love to have founders kind of reapply, because I think as they start to ideate and figure out, like, how can I make this a $10 billion business, a $50 million business, a $100 million business, you start to see that evolution. It's actually very powerful. So, but anyways, that power law phenomenon is probably the number one thing that I always think founders are like, oh, wow, okay, I didn't realize we had to be that big, and we have to actually grind to get to that level, right? And so, but like Ben said, there's so many different ways to fund a business, and you have to figure out if your business is right for VC or if it's right for other types of capital, right? Obviously, banks have been around forever, and no one thinks about it, right? Because it's not like the typical route for a startup, but for some startups, it actually makes sense. And so you just have to kind of understand where you want to play. In terms of misconception, one of the things that I always hear is, gosh, that investor rejected us, we must not be a good business. And that's definitely false, right? I will tell you, especially at the early stages, there are many great businesses that we just won't fund, or someone won't fund. It's not personal. One, never take it personally. Two, just keep going, and you're going to get, like, I was a founder previously. We went through at least 50 VC meetings before we got one term sheet, which sounds depressing, but I have friends that have gone through 100, 200, and then they've gone on to raise like a Series A, Series B. Like, you can go through all the stories. Facebook didn't get funded, early on, right? Like, it doesn't matter. Like, you just have to know that you have to find that right match for whoever is giving you capital, right? Anyone across the stage here, versus what you're building, right? And so that's probably one of the big things. There's a question. I don't know if.
From your perspective, what would make those startups of 1,000 applicants stand out to be one of the 10?
Oh yeah, I could go on for hours on that one. I guess we can dive into that a little bit later, but yeah.
Grace, anything to add?
Well, I was just going to say that I think in the startup community, kind of agreeing with these guys, not everybody understands the scalability of the company that they want to launch. And I think that VC money is one of the last resorts for you. I mean, we have so many people come through and they just want to create a job. They just want to provide for their families. They just want to do a mom and pop. And those aren't scalable, investable ideas. If you want to be the next, fancy restaurant, or if you want to scale something, that's a different kind of model. But at the end of the day, I mean, VCs are going to take equity. Like, they're going to take your firstborn and your secondborn and your thirdborn. Like, these are babies that you guys are birthing. And I don't think that a lot of people understand that when they get these term sheets, that you're giving something for that money. And so if you can hold on to your company 100% as long as possible, then you will have more control, you'll have more independence, you'll have more freedom in that direction. And I think you have to keep in mind what that means when you are talking to VCs. If they do return your phone calls, if they do take a meeting, you may not know what you don't know, because a lot of it is this financial information on the back end that might be over your head. And so you really just need to be really, really intentional about even the kinds of VCs that you reach out to. And know, like you said, I have a philosophy that I share with our startups, which is, 1,000 no's. If your goal is to get to 1,000 no's, then the first 500 will be like, cool, I'm on my way, gold star. And then once you start getting the yeses, you're like, wow, that's how this works. And so there's a filter so that you don't take it so you don't take it personally. You don't get emotional. You keep going. And it's a long game. That's the other misconception, is that people think, they're going to come, they're going to start a company, they're going to get funded, they're going to exit, rinse and repeat. And these are years and years and years of real boots on the ground stuff. So I think you have to be patient and you have to be realistic.
Yeah, that's a really great point. And I think what I'm hearing from the panelists is venture capital should really be kind of the last option, not the first one that you go after. Like, once you know you have a scalable company and it's going to be that $100 billion, that's kind of when it's ready. And I think that's really powerful. But I'd love to move on to kind of digging into some of the alternative fundraising sources. And Grace, I'd love to start with you, actually, because who in here likes free money?
I don't know if it's free per se, but
I mean, it's free compared to venture.
okay. So if any of you had the chance to look at the work that I do, I helped co-found an organization called Make Startups. And we started out as a nonprofit over 11 years ago. And really what we do is we help champion startups working mostly with entrepreneur support organizations. And we use the acronym ESOs. This university is an ESO. And so the idea that you would work with organizations that have access to capital, regardless of where you are in this country or even on the globe, they exist in your communities. And when we started, there was the maker movement, there was the hacker movement, there was the dawn of the co-working space. And so we started all three at the clubhouse. And what has evolved is that these ecosystems have access to capital, whether it's through foundations, whether it's through federal government, state, or local. A lot of times they will work with grants that are relatable to certain demographics. And so reaching out to them, whether it's through LinkedIn or through wherever you are based on industry or geography, there's usually access to quote unquote free money. So it's probably an application, it might be a pitch. And sometimes it's as little as $5,000 and sometimes it's as big as $500,000. And I can get into more details daily about that. But really, it's the entrepreneur support organizations that are going to have access to those networks. And so the more that you get to know them, whether it's through their events or their communities or getting more involved, you'll find that they'll have funding options that you wouldn't even know about because you're building your business. Those ESOs are the ones that are going out making those connections and creating those introductions on behalf of you.
And I think there is a lot of startups in the room today. It'd be very helpful, I think, to just talk a little bit about the profile of the right startup for those kinds of grants, what that kind of startup looks like. So somebody in here can be like, hey, that's me, and I should definitely go after that.
I mean, I think the ones that we've worked with have gone anywhere from, the idea stage to maybe they're already producing revenue. They already have customers and they want to scale. And so really you have to sort of meet the ESOs where they are. I mean, I can talk about, maybe everybody in here wants to end up at like Techstars or Y Combinator, but there's ESOs again in regional areas that whether they're rural, whether they're urban, they could be, women driven, they could be marginalized communities. And a lot of times there's fundings that are set aside for that. And so like one example you'll see is a lot of economic development agencies. They might be talking about bringing jobs to your communities, but what they don't talk about is new jobs. And you guys are creating new jobs as entrepreneurs. And so there's usually funding related to that. And that could be funding even to the point of like tax breaks or incentives for your real estate, or it could be subcontracting with your government agencies because they have to do set-asides for small or minority-owned businesses. And so a lot of times that's free money, but you have to go out and find those things. And again, the ESOs are going to be the conduit to finding those things because you may not know that they're available, but they're in every city, county, state, and federal landscape.
Out of curiosity, what is the most grants that you've kind of seen distributed?
I mean, we've had companies that come through our space that have raised millions and millions of dollars. Our organization has gotten over $1 million through grants that we give, and then that we turn around and we help our startups with. And so a lot of times, some of these events that you'll see, they'll have $5,000 or $10,000 or $15,000 checks, and sometimes that's all you need to get started. And that money will have come from these other agencies.
Yeah, which is pretty incredible that you can raise millions today just from grants. And I think a good segue to that is, let's say you need more capital or you're not necessarily qualified. Ben, I'd love for you to talk a little bit about crowdfunding. Everybody in the room probably is relatively familiar with crowdfunding, but maybe not exactly the details on the different types of crowdfunding and the vehicles. So I think that'd be super helpful.
Sure. So crowdfunding's been around for a long time. And it really got popularized by your Indiegogos and your Kickstarters. And we all probably signed up for some product we never received, and maybe we got a t-shirt and that was cool. We felt like we were participating in some kind of innovation that we saw. I remember the first one that I invested in was this amazing team out of Dyson, actually, which is like an incredible engineering organization. The amount of IP that comes out of Dyson is nuts. And they were going to build this headphone system, a little like, it was like an AirPod, this is like 2012, that had this super rich sensor system in it. It had a little AI in it, and their video was incredible. They had this skier perched at the top of this mountain and probably in the Alps. And as he's declining and swishing and swooping down the mountain, the AI in his ear is reading, this is your speed. These are the G-forces that you're getting on this turn. Put more pressure on your inside foot when you're turning it up here. And like, oh my God, there's a cliff over there. Don't go over there, because it's able to access all these maps. This thing never existed. It did not exist. It could not exist. The sensor technology was not there. The compute capabilities were not there. I invested because I was working for Plantronics at the time. I cared about microelectronics and headphones and the application of voice command. And that was really cool. I felt like I was participating in that. And they raised like $500,000, and nothing came of it. Company never got anywhere. It went. All those really brilliant engineers went and did something else. And that was crowdfunding for kind of a long time. And it started to mature for a while. Indiegogo did a really good job partnering with Fortune 500s to help them use consumer demand in order to generate new products. So Kohler and GE and all these like very large consumer brands started using consumer feedback to get buy-in on their vision for new products. And that was when we really started to see this engagement with a community to form new ideas for companies that already existed. Then in 2014, the Jobs Act got passed, and nothing happened for 2 years because the Jobs Act didn't actually enable Reg CF to be investable. But it was a start, and it took a lot of really hard work from people going to work in DC and advocating for entrepreneurship to get that to finally unlock in Reg CF, which the first campaign started getting run successfully in 2016. We saw WeFunder, we saw Start Engine, we saw Republic, and they were raising tens and hundreds of thousands of dollars in equity to regular people, which was pretty amazing. We sort of transitioned from me believing in this cool set of engineers, hoping they would go do something, and literally lighting my money on fire, to then going to the WeFunders and Start Engines and Republics of the world, where I could light my money on fire, but I could get equity in return at least. Now I was holding real shares in real businesses. But the problem was that so many companies were going to those marketplaces as a last resort. They tried to go VC and didn't get the response, because it turns out it's super hard, like we've been talking about. Like almost no one gets funded this way. And so they go to crowdfunding as kind of a last resort, which means they go underfunded, because a crowdfunding campaign is a marketing campaign. It's highly regulated. The product you're selling is actually equity in your business. It's not a widget. But it is a marketing campaign, which means you don't do it just like, you don't put it up there and hope everybody comes. Like I can go post a product on Amazon right now and I can sell no products unless I market it. And the same thing's true with equity crowdfunding. So it took us a while to figure that out in crowdfunding. Eventually, we started getting some really high quality campaigns on the marketplaces where there was excellent marketing done. Like that same product video that inspired me to invest in that headphone, that quality of content then started coming out around crowdfunding campaigns. And people started getting really inspired, because these are early stage startups, which means you have to tell a really compelling story. The markets continued to evolve, and we started to raise, a couple of $1 million instead of a couple of 100,000. Higher quality content started coming out. Higher quality companies started looking to crowdfunding, because they started to see the compelling value proposition of staking an entire community of people who care about a business as part of their growth plan. Not only is it likely more affordable capital than going venture capital, because you're going to get usually more friendly valuations, but now you have like a couple of thousand people who love what you're doing. And if you're a social company, if you're a consumer company, anywhere where you actually need people using your thing in order for it to be successful, or word of mouth as a key component of your product marketing plan, then crowdfunding is actually accretive to the whole business model. So now companies start spending pretty significant budgets to raise a couple of $1 million. We started maxing out a couple of campaigns now. Then we started hitting that $5 million threshold. The SEC started really paying attention and opening up some of the rules, making it more accessible. And so at the time, I actually founded my own equity crowdfunding platform called Fundify. We launched that in 2021 because we saw that the regulatory environment was finally there. There was high investor demand. There was a high demand from startups to look to their communities for capital. And we started to scale. We found this really interesting challenge. It relates to the kind of the essence of how crowdfunding was built, which is that if you're on a marketplace like a WeFunder or Start Engine Republic or Fundify, my own platform, you're now competing with the startup next to you in a truly zero-sum game. The same way if we do a pitch competition and there's only $100,000 to give out to one startup, it doesn't get split. It's not 50 and 50 to the best two. It's 100,000 to one and 0 to the next. It's the same with retail investors. They are working with finite budgets and, more than anything, finite attention. Going through 2 transactions on those marketplaces doesn't happen. So we started seeing this inherent threshold of productivity because you're driving a significant amount of traffic to your campaigns. You're building this massive community. All these people who believe in what you're building are coming to your site on WeFunder, Start Engine Republic, Fundify, and they still are only converting at like a 1% conversion rate, which is pretty good, but you lose them there. They're no longer members of your community. They're now users on a marketplace. The same way if you're selling a product and you market it somewhere and then you convert me on Amazon, well, now I'm just back on Amazon. I'm going to start like looking in my cart and I'm going to wander away and I stop caring about you. You're the reason you brought me there, but I'm not staying there because of you. That's where Dealmaker came in and really transformed the industry yet again, moving from the marketplace to what we call self-hosted fundraising. And the reason it's transformed is that if you're a serious brand who's looking to drive millions and millions of people through this investment process, through this community building process, you don't want to send them to somebody else's website. So you need a place to send that high amount of traffic that's going to have a higher conversion rate that's also going to be truly accretive to your community and to your business. Once that model took off, we started seeing fundraisers to the tune of tens of millions of dollars per campaign. We started seeing companies leverage crowdfunding, not just from testing your idea on Kickstarter, not just that initial early community of believers on WeFunder, but to consistent and repeated access to retail capital markets, all the way up through IPOs. So about 3 weeks ago, there was, or maybe about a month ago now, a company IPO'd on the NASDAQ who 2 years earlier started crowdfunding with Dealmaker. We raised a couple of million, then we raised a little bit more than 10 million, then we raised a little bit more than 20 million in 3 different campaigns, totally recapitalizing this business. They never had to go institutional, they never had to go private equity or VC, and they generated so much retail trading volume that the NASDAQ IPO'd them. They skipped all these typical steps in the process because their community believed in them, and they were so liquid and they were so well capitalized that they dramatically accelerated their company timelines. So and that's 10 years before that, we couldn't figure out how to launch a single crowdfunding campaign in 2014. In 2023, companies are doing it for their entire life cycle, all the way up through IPOs, and even doing private debt offerings while being public. So we've matured a lot. It's pretty exciting.
Yeah, that is pretty amazing. So theoretically, let's say I'm a startup founder and I've identified that crowdfunding is the way I want to go. What would be really interesting is, what do I need to mentally prepare myself for? What is the hardest part of crowdfunding? Because you make it sound so easy.
Oh yeah, super easy. Yeah, no problem. So it's hard. Like every one of the versions up here that we've talked about, they're all hard. There's no easy path. Sorry, guys. we're all four of us have all the scars to prove it, probably, for our own trials and tribulations. The thing to really prepare yourself for is a couple of things. One is it's not cheap money. So you're going to get better valuations, but it's cash intensive. So one of the things we often see people doing is stacking capital products in order to fund crowdfunding and maintain a healthy cash position while doing it, because to build that awesome video that I talked about, videos are expensive. Like, ask these guys back here. Like, it's really expensive to do a really inspiring product and company video that could cost you tens of thousands of dollars. Most early stage companies don't have that kind of budget. So definitely preparing for content expense, preparing for consistent and ongoing distribution. So you need to be able to get in front of large audiences. It's one of the reasons why the marketplace models are really good when you're just getting started. So if you need to raise a couple of $100,000, you're probably better off going to WeFunder, Start Engine, Republic. There's a long list of them now, because you're going to borrow some of their community. Usually their upfront costs are a lot less, so you can kind of get started quick. But the hard part thing to prepare is, like, it's a long road to build that community, and doing it strategically can, like, set you up again, like, to totally skip all those steps and eventually to IPO. But it's a lot of cash, and it's a lot of work, just like it's a lot of work to go VC or go a different route.
Fortunately, I think my battery died here. And I think we have one quick question.
Crowdfunding where you might potentially undersubscribe the round, but if you're able to hit the KPIs for the subsequent round rate valuation, that you can take part of the money, or do you have to, like, complete the round, similar to how on Kickstarter it was like all or nothing for a lot of those fundraisers? Is it the same way, or can you do the rolling round?
Yeah, so I guess one of the things that you need to prepare for in crowdfunding is there's all these tactics and there's all this kind of gameplay to optimizing how you utilize crowdfunding. So one of the things you talked about is, do you have to close your round above or at some certain mark in order to get liquid? There is a specific rule within your filing that you do with the SEC that says, the SEC actually calls it a target raising amount, which you can set wherever you want within reason. So setting it at $1 million on a $5 million fundraise is actually not a very good idea, because by law, you cannot take that money out of that account until you hit your target amount. So set it for 10 grand. And once you're at that $10,000 mark, then it's up to the broker dealer or the SEC intermediary, your platform you're raising it with, as to when you can draw out of that escrow account. Under Reg CF, by law, there needs to be an escrow, which means that usually there's certain rules as to how often you can disperse out of that. Regulation A financings, which are the bigger crowdfundings, you don't require an escrow, which means you're more liquid. So you can get cash out of that round faster, and you can also revalue. So like you said, what happens if you hit your KPIs midstream? Well, increase the value of your company. And there's legal requirements that come into doing that, and I recommend you consult with your attorney to plan that, and consult with your broker dealer, your SEC intermediate about what that strategy looks like. But those are actually the kind of questions that enough founders don't ask. They assume, okay, I've just got to hit my mark, and if I don't hit my mark, then, like, shucks. In crowdfunding, there's all of these different tactics, all this different gameplay you can use to make it fit what you need, because it's yours. Like, the whole campaign belongs to you. There's a framework the SEC sets out. You set the rules.
Like a question involving SEC and crowdfunding: are you able to market your crowdfunding campaign as freely as you would, say, a T-shirt that you made, or is SEC still have some pitfalls there?
So not as freely as a T-shirt. This is a regulated security. You are also selling this to investors. Just because they're retail investors does not mean that they don't deserve the same level of disclosure as a professional investor or an institutional investor. That said, there are very specific, very well outlined rules as to how you can market it. It is not general solicitation under Reg CF or Reg A. There are rules. Making sure that you know those rules is very important, and making sure that whatever marketers you work with understand those rules is very, very important. They do check.
Yeah, because the main thing I visualize would be like sharing a link to like some kind of due diligence room, but like you could share that
Yeah, and look, let's follow up after. I can walk you through all the things. I can share lots of examples, and there are some really great examples of companies that do this excellently, that leverage that really high quality content, that are incredibly compelling, but do adequate disclosure. These are investors with you. Like, they have to know what's really happening in the business, but they're retail investors. So how you communicate that is not the same way you would communicate with a fund.
Very quick question. Can you also quickly touch upon deal distribution? Like, is this more of a tools and a toolkit, or you also help with outreach and deal distribution?
So Dealmaker in particular, we have kind of two paradigms. We have one where so essentially there was a marketing agency in the crowdfunding space called Ridge Growth Partners. They were the best in the industry by a lot. Dealmaker acquired them about 9 months ago to bring them in-house, where we provide both the total distribution, all of the digital advertising, the media partnerships, everything you need to reach the massive audiences required to raise, $75 million. We do that as part of a service internal to Dealmaker. Most of the platforms have some version of that. I would recommend that you, however you consider crowdfunding, is that choice of your broker dealer, so how you actually legally convert that transaction. That's probably the most important choice you make. The second most important choice is who markets it for you. So that's a great question to ask. There's a lot of different types of services out there, so sometimes you have to cobble together a few.
Yeah, I'd love to switch gears here to Leonard and accelerators, because accelerators, especially the most prestigious ones, are just as competitive as venture capital. So I'd love for you to kind of compare and contrast how accelerators really differ from venture capital and VCs, their role in the industry. And frankly, I'd love to hear, like, how do you get into one of these prestigious accelerators if you're a startup?
Sure, and maybe I'll start with at least accelerators in general. So there's probably two major types of accelerators. There's investment and non-investment accelerators. So you should just know that going in. We have both, actually, but I'm the head of our flagship program, which was the one that started with 500 way back in 2010. We put in 150K, 6%, et cetera, right? So it's similar to what you would see at like Techstars, YC, et cetera. We also do have later stage funds. So similar to Draper, we have 30 funds globally, right? So we will invest regionally, et cetera. But the accelerator itself is a program, right? It is meant to help companies that we find have the potential to get to 10 billion, 100 billion, whatever it is, to help them actually get to the next stages or next milestones of their business. And so we work with them hand in hand for 4 months. Probably one of the bigger things is we take a very hands-on approach. I think other accelerators might be a little bit more hands-off, which is fine. Like, I think it just depends on what you're looking for. But we get very much into, okay, how can we help you figure out product market fit? What does that actually look like? How do you run experiments quickly enough, right? And so going back to one of the earlier questions, what's the quality of a team that we might look for? It's speed of execution. How quickly are you running experiments, right? How quickly are you launching? And so, if a team takes 6 months to launch, that's kind of not fast enough, unless you're deep tech, right? Like, obviously, like, there's areas where it takes a lot longer. Like, we should see you launch within a week, a couple of days, right? Like, it doesn't take that long for a lot of the businesses that we see. We should be able to see you run experiments multiple times a week. And you should be able to say, like, okay, this isn't working, this isn't working, this isn't working. Here's the KPIs for why it's not. And so we want to help you figure that out, right? For a lot of first-time founders, when I was a first-time founder, I had no idea what I was doing, right? I actually thought I knew everything. And then when I went through, I actually went through 500 myself before we raised our later VC rounds. But when I went through it, I was like, oh, I kind of have this figured out. And then my eyes like opened up and I was like, oh my God, I didn't realize I was doing everything not efficiently, right? And that was super helpful. And you learn so much from the other founders, right? So I think from that standpoint, it is amazing to kind of go through any of the programs that you can kind of get into, right? So that's at least the accelerator portion. You can get a direct investment through VCs. Typically, you just pitch them, they'll give you a check. They may or may not sit on your board, but there's not necessarily that like active involvement in your business building, right? And so the accelerator really plays at the beginning stages of a lot of companies that go down the venture path specifically. In terms of how to get into it, there's one, every investor probably has their own criteria for what they look at, even on our team. Literally, we are reviewing teams all this week and next week for the next batch. And we're going through back-to-back interviews, and we're all picking up on slightly different qualities of those teams. So that's why it's a hard question for me to answer. I can tell you what I see. And so speed of execution is one. Obviously, do you have expertise in this area? There's a lot of common things that we'll see, but I'm happy to, if you guys want to dive in more, we can chat afterwards, or find me on LinkedIn, we can talk there. But there's so many ways to kind of stand out that it's hard to like pinpoint one. But you definitely need to be in a big space, right? Going back to kind of the market size, that is for sure one. We see a lot of companies that it feels too small. And so if you're just not building in a big enough space, it's really hard to fund that kind of idea. Even if we love you, even if we think you have the qualities to make it, it's just going to be very difficult to get us past there. So that's probably one of the bigger ones. Let's see. We could probably go on for a while on that one. So if there's anything specific, I'm happy to kind of dive into it. But like,
Yeah, I think it'd be interesting if you talked about what the actual deal structure is, like, because 500 is an investing accelerator, right?
Right.
So
right.
how much money? Kind of what is the equity structure?
Right.
And then your relationship with VCs, because you work closely with VCs, but you're not a VC, right?
We are VC in the sense that we actually have a venture fund.
Right.
So we have $2.7 billion asset under management, right? So we have, we've invested in these companies. At the accelerator stage, it's $150K, 6%. That's sort of the standard deal, right? And then we can invest later on as well. So like as you get into your seed, that's more of a proper pre-seed, let's say. We can invest in like the seed round, potentially Series A. Like we just did, we have a Indonesian startup that just did I think they're like at $1.6 billion round. Like, and we invested into that round, right? So like, so it just sort of depends on what the company is. And usually we start at the accelerator stage, we make that first investment, and then we'll kind of follow on in certain companies as they kind of grow. So, actually the one thing I would say that really makes you stand out, build a fast growing company. Like so many people come to us with a pitch deck, which is fine. But if like we can't prove that there's actually something meaningful here, it's like there's no signals that we can show that this is actually going to be a much larger business, like it's going to be difficult to fund. So the faster you can grow and we can see traction, I don't necessarily even need revenue. Revenue is obviously the easiest form of traction, but there's other signals that we can look at that can say, hey, there's something really here that consumers absolutely love. And so you'll meet a lot of VC firms that actually are scraping a ton of public data and private data to understand the metrics to get early signals of what is a venture scalable business. You guys don't know these numbers. Like I was talking to another firm last week. They have, they consume over 3 terabytes of data a day to analyze and understand for every sector that they play in, what the key metrics are and drivers. So when you come in and pitch them and you show them the numbers, if you aren't above the bar for a venture scale business, they won't go, right? Like it's just not even they're not gonna bother. Once you get to that point, then they're like, oh, there's something interesting here. Let's dig in. Let's lean in and figure out what if this makes sense for us. That's why I'd say first and foremost, build the fastest growing business you can, right? And I know that's hard because everyone's like, well, I need capital first. I need to be able to hire people. Yes, but no, right? Like you have to think back in, I don't know if anyone was around at this time, but like, 2010, there was only 80 seed venture firms at the time. So there was no capital at that point. People had to figure out, and back then, sometimes people were still using servers, like physical servers that they had to build. So it was way more capital intensive at the time, and they had so little capital, and they still had to build, right? I think we've gotten into this mindset, especially in 21. 21 was an anomaly. Like, wipe that from your memory. That is not going to happen anytime soon. Maybe it will again, but like so many founders are like, well, but I can raise $5 million because my buddy did in 21 off of a pitch deck. You're like, well, yeah, different time frame. Like you just have to understand, like we're in a different era. But the best companies now that are getting funded are the ones that found something that is actually sticking and working and growing. And so all those companies in 21 that raised that haven't found product market fit and aren't growing, they're not going to be able to raise that next round. So just know that's the biggest issue.
I think we also had a question in the audience as well.
So if speed is a priority, obviously you need 2 different data points to evaluate rate of change.
Mhm.
So if someone is applying to your accelerator for the first time, are you more likely to reject them and hope they apply a second time to actually be able to see what they've done in the meantime?
Yeah, so for sure. I would say I personally actually love finding great teams. And then I don't care if you come to me with a pitch deck, that's fine. Like you don't have to have much built. I want to then work with you, maybe talk to you over like maybe months, right? And just see how quickly you can build, right? That gives me a better sense of what you're capable of. Because a lot of times people will be like, hey, I just want to pitch you. And if you don't fund me tomorrow, I'm never going to talk to you again. Fine, that's okay. Like you should actually talk to as many investors as you possibly can. I'd say in this environment, you want to get to know investors for a longer period of time because there's 2 ways to think about it. If you can occupy mind share of that investor, unequal mind share versus every other founder that they meet, they're more likely to invest in you longer term, right? Even if you don't have something like tangible to really show them, right? But it's because they're like, okay, I know this founder has the qualities that seem like they can actually make something really big. And so, there's tons of founders that I know that we have not funded yet, but I spend a lot of time with them, and I'm constantly helping them on the weekends. Like we'll do calls, we'll like chat through things. They'll text me about like, okay, hey, I ran this experiment. This is what I saw. What do you think? Right. And then we'll just kind of go back and forth. And like, that's a partnership that we want. And so that's more of like what's more typical for at least me.
I wanted to just add to that so much of, I think, what we're all talking about is kind of like a hurry up, and then it's going to take a long time. And so you might be getting mixed messages here, but I think the pattern here is that it's like a relationship. And so I have evidence from even the work that we've done where, as a nonprofit, we had applied for grants. We didn't get them. We went back the next year. We didn't get them, but we got a call with the program manager. The 3rd year we got them because they remembered us. And so the traction with a startup is that the first no is like, cool, they replied. Maybe put them in a bucket and then reach back out to them in 6 months or 9 months, find out when the next cycle is, find out what they're doing, be proactive in keeping that relationship going, because none of this is personal. I mean, unless you're a real punk out there, they're going to take the call again, or they're going to respond to the email. And we have examples of, when we started our organization in 2014, we were outside of Atlanta, Georgia, and we had a real well-known VC come and give us advice and give us some support. And I reach out to him, every year, just kind of dropping information, dropping data, dropping evidence of our wins. And then, 6 months ago, I reached out to him again, and I was like, hey, we want to talk. He's like, cool, let's talk. And I think one of the bittersweet byproducts of the pandemic was that there's this virtual community out there that wasn't around 4 or 5 years ago. And so whether it's a virtual incubator or an accelerator, you're no longer geo-bound to showing up to places. And so you can take these conversations, you can take these Zooms, and a lot of times it's just that persistence. And until they absolutely never call me again, which they actually rarely do, you have to continue that conversation. And you do it with funders, you do it with VCs, you do it with angels. You just have to be consistent and persistent.
Yeah, I think that's a really good point. I have a saying where it's build fast or build hard. Just out of curiosity, how many founders in the room are building deep tech? So
They're kind of doing it. So
yeah. But I have a question for all 3 of you, actually. So one common kind of theme that I saw is that every form of kind of alternative financing here has seen massive evolution in the last decade. And we're in Silicon Valley, and I love talking about the future. I want to know, what is the next evolution in crowdfunding, the next evolution in accelerators, the next evolution in grants, and non-dilutive And Ben, I think you're eager to start here.
Yeah. So I'm going to talk about kind of a narrow evolution that's happening right now. And in my space, we're going through a lot of regulatory change, which is really important. And one of the changes that's happening right now, there's like 5 or 6 bills that are in the Senate related to continuing to grow the pie in crowdfunding, making it more accessible to retail investors and opening up the asset class even more. So one of the things that I'm particularly excited about is the potential for retail investors to invest into funds. So today, in order to invest into a startup, you can be a retail investor as long as you're investing through Reg CF or Reg A, you're allowed to invest in a startup. That's great. That's a big step forward. But there's still this other closed off asset, which is funds. And funds are incredible ways to create wealth. It's also really hard to raise a fund right now. Daniel and I are actually both doing it ourselves. And by a lot of blood, sweat, and tears, we are raising some money and we're writing some checks to startups, which right now is really, really hard. Well, it's not me.
Apologies. That's my parking.
Oh.
So
I don't get a ticket.
So one of the things I think is really transformative right now, you see so many emerging managers quit. You're seeing so many emerging managers shrink the size of their funds, take way too long to get to their first closes. And I'm really excited about the potential for retail investors to invest into funds because I think it's going to continue to grow this class of investor that is much more focused. They're much smaller. You're not a $10 billion Tiger Global fund that's just like racing to deploy capital as fast as it possibly can. You're one person with a couple of $1 million focused on a small community that you care about and you're really connected to. I think that's a future I like. And one of the things that's a really cool example of this is Jason Calacanis' Fund 4. He went on his podcast and he said, hey guys, I'm raising my 4th fund. Send me an email and you can get in. He announced that publicly. He raised under the Reg D 506C exemption, which legally allows him to generally solicit the fund. And that means that, and he got I think all 250 spots filled up, raised like $68 million in like 2 weeks. And those were still only for accredited investors. Could you imagine how much money he could have raised if that was open for retail investors on something like a Reg CF or Reg A? It probably would have been a pretty darn big fund and would have created a lot of wealth for regular people. So that's a future I'm particularly excited in. And we are getting called time pretty soon, so I'm going to stop talking.
You still got 10 minutes.
I can talk for 10 minutes. That's good. Oh, okay. Yeah, I should probably stop.
Grace, do you want to dig into that?
Yeah, I just want to ask a really quick question. Raise your hand if you are within 150 miles of us right now. Like, did you come from 150 miles? Okay. And then raise your hand if you are outside of 150 miles of us. Okay. So I think it's maybe 50-50, 60-40 or so. So one of the things I want to reemphasize is our tax dollars at work, guys. That is kind of free money. It's like a flywheel effect because you're paying your taxes and the government is turning around and giving it back to you in certain ways. And so if you think that you have something that could be fundable at the state level, at the federal level, there's SBIR grants that are specifically, when you're talking about future funding, that are doing, again, the set-asides, whether you're in the Bay Area or whether you're somewhere else in this country. You can tap into that money. You might have to partner with an agency or an institution or an academic community, but that can be anywhere from $50,000 to $500,000, and it's specifically for for-profit startups. If you go after SBIR grants, if you go after the NSF, if you're going after different departments, they're not political. This is a bipartisan thing. The other thing I would say to you is that every state in our country, I'm pretty sure, runs a fund, and so they're called different things. So, like in Maryland, it's called Startup Maryland. In Georgia, it's called Invest Georgia. And again, these are tax dollars that are put aside to help startups in their communities because you're creating jobs, you're expanding the tax base, you're being innovative, and every state, including California, wants to say they're the most innovative state in the country or that they have like easy money because they're trying to recruit you to either stay there or not leave or move there. And so there's a lot of incentives working with those government agencies to find that money. And again, it can range from, a $10,000, just here's a check, good luck, to tax credits, to like free rent for a year for your business, to incentives for job creation. There's also training. There's trainings where as an entrepreneur, you could actually get reimbursed for education that you're taking on how to build your business. And so those are the things that I've seen in my industry that are moving forward, because they're trying to distribute the federal dollars and the state dollars. As much as I love the Bay Area, they're trying to make sure that entrepreneurship exists in every city in our country.
Leonard?
I might just add quickly, one of the things that at least I see from more of the venture lens, I suppose, is the next 5 years, we're going to see the pace of innovation exponentially grow. You guys are probably already seeing this, right? Gen AI is making development much, much faster. And so what we saw was, if you look at the history of innovation, SaaS was one of the bigger things that helped startups to deploy much faster, right? And now I think we're getting into this next wave where Gen AI is going to make software development so much faster. So we're going to see this huge wave of innovation, not necessarily just Gen AI specific, but I think just in general, we're going to see coming out in the next 5 years. So we look back at the GFC, the great financial crisis back in the late 2000s. You had companies like the Airbnbs, the Ubers, the Stripes of the world, like sort of come out of that region. And we're going to see another wave of companies now. And so we are incredibly excited for the companies that are being built today. Also, partially because we've seen a lot of the tourist entrepreneurs sort of fade away, because 21 is no longer here. They're like, oh, I can't just raise $5 million off of, showing up at one VC meeting, right? Like, and so you actually have people who want to build, who are actually really excited, and they're going to grind to make it happen, and they're going to figure it out because they're willing to put in the effort and whatnot. So I am extremely excited for all of you. I know it's hard. Like I completely get it. Like and I always empathize with everyone who's building. And so I cheer you guys on. I know we're out of time. Obviously, come find us. I do need to feed the meter really quickly, and then otherwise I'm going to pay a pretty large bill, I'm sure. But I'm happy. I think we're happy to chat for a little bit afterwards, and then obviously come find us, on socials or whatever. So,
Do we have time for one audience question? I think I saw your hand go up first, and then this and that.
It's a general question for whoever wants to step up to it, but you mentioned just a few minutes ago that limited partners are investing less in your funds. It's a big challenge. What would you say is the biggest reason why that is? Is it as simple as interest rate number go up, or is it a looming recession? From their perspective, why would that matter? In a way that we can understand and accept that.
So the way I explain it to myself, which there's a lot of explanations for this, it's also incredibly fund dependent, network dependent, LP dependent. The way I like to think about it is venture capital is about the riskiest place you're going to put your money if you're an LP in a fund. If you're an LP, you're a family office or an institutional investor, which means that you don't just invest in a single asset class, you have a whole array of asset classes. Venture essentially being the most risky, except for direct startup investment. When interest rates go up, all of your capital kind of shifts away from that, because interest rates are going up, which means you now can put, if I can get a 5% annual yield on a bond, well, that's pretty solid. That's half of like an underperforming venture fund. Like if you're a venture fund, you're doing 10% IRR and I can get 5% on a treasury bond. Well, oh my God, like this is a pretty good deal considering I know that money gets paid. This money's locked up for 10 years and I don't know how it's going to do, especially if you're a fund one. So generally, I think about it as more conservative investments become more lucrative, the place that money often comes from is from the more lucrative, the more risky, high volatile side.
One thing to also know is LPs are, if you think fundraising for your startup is hard, it's orders of magnitude harder for an emerging manager. They've actually dropped, I think, 90% year over year in terms of the capital that's been deployed to emerging managers. It is so tough right now that I would say, and the reason being, interest rates is obviously one of the major driving factors here, but DPI. So we have something called distributions back to our paid-in capital, et cetera, to the LPs. If you can't actually exit a position in a company, let's say Stripe or whoever, right? If the VC firms aren't returning capital back to those LPs, they can't invest in that next fund And guess what? They're going to invest in managers that they've worked with for years. It actually takes the average emerging manager maybe like a year or two to raise their fund, somewhere in that vicinity. You guys might be able to raise around in like, a couple months, right? Like it's just that much harder because the LPs are more conservative. They spend maybe only 5% of their allocation, their capital base on the VC asset class. VC asset class, just so you guys know, has been the top 3 of all private equity classes that LPs typically invest in for the past decade. It wasn't the case back in the early 2000s. Traditional PE, real estate, all this other stuff was always like prominent, but VC has been outperforming the market. And so, more and more LPs are investing, but they're still really risk adverse, right? That's why it's such a small percentage of their overall capital that they deploy.
I think we had a question here as well.
Since you were mentioning traction, I'm actually from this deep tech thing where you said that's kind of a problem sometimes, right? Because so I'm asking, what could you be like you do? I mean, you said before that venture capital is like the most expensive from my perspective. That's true, right? But if you do something like deep tech, you need to develop something. You need some time. And you need to break up a team, right? Some people, but essentially also, that's why I was thinking about venture capital to be a good thing, because you can add this business perspective to people who are from tech. I mean, I'm really good at what I'm doing, but I'm not from a business side. So I think that's, for me, this would be kind of adding value because there are people who are actually from business and who are experienced in how to raise businesses and whatever. And now if I try to apply to like VC or angel investors, whatever, I see that I'm more or less measured by values that are specific to the business, not specific to the tech. And of course, I cannot kind of convince people in the other thing, which is not my thing. So what would you suggest in this case? I mean, accelerators also exist, right?
Yeah.
But they want like more than 50% right from the start usually.
Right. And I know there's only a couple of deep tech folks here, so I won't dive too much into this, but there's milestones that you have to reach for whatever you're building. So like we're dealing with a space tech company right now that's building a new way to launch satellites. And they have milestones that they have to meet from a technical perspective, right? And so that's all lab testing. It's not something that you're not going to get revenue. We're not going to see revenue for like at least 5 years, if not like, longer out, right? So we will understand what sort of the milestones are for your specific space that you're building in. And we just want to see your progress towards those milestones. At the very first stage, it might be, am I bringing together the best experts in whatever I'm building? Like if I'm looking at the top companies that are trying to develop this technology, do I have the best minds here, right? And so we've done a lot of DD on the team members to see like, hey, are they well regarded in this space? Like, are they publishing the papers that kind of push the thinking forward for whatever they're building? Right? Like, that's what we're essentially evaluating the very early stages for a deep tech company. Very different from like a SaaS company or whatever else.
I think that's why also we emphasize your founders, your co-founders, and your team. I mean, he's looking at the team. He's looking at the bios. He's looking at your lived experiences. I mean, I think we all agree, like not everybody is going to an Ivy League 4-year. And so whatever you're wrapping around your team, maybe that is the business element because you're in the trenches of the technology, but you need somebody to kind of bridge that gap.
One also thing to add is there are deep tech VCs who understand this intimately and can be great partners for that. They are still expensive. Like it's the same model. They just happen to know you better. So something that I advise a deep tech company right now where the technology they're developing is explicitly applicable to an industry that I have a lot of experience in. And I'm able to look at the technology that they're developing and going, I know when that solves the problem for this industry. So I was able to work with them to establish what those milestones were to then, get them ready to go to VC such that they could communicate it in a method that those VCs would understand. So sometimes you have to go the VC route if you're talking like space tech where your timelines to revenue can be 5, 10, 15 years, or biotech is a similar pattern. Sometimes deep tech doesn't necessarily follow that pattern. It's more that you're truly inventing a net new methodology that you think is disruptive to a specific industry. You have to figure out how to communicate your value to that industry, though you're deep tech. So it's a challenge, and you need expertise, and you need a combination of investment and business expertise and domain. It's a smaller subset of us.
Interesting, because I mean, you all mentioned like things where you already communicate, but I don't even get to the point where someone listen. So that's more or less the problem. I mean, if I could communicate with someone, I know what I'm doing. I think this is the last 5 years, and another company there, and I'm spending a whole lot of money with it. I want to do it myself, but I don't even get the point.
You can talk to us here. It's fine. We're here.
Yeah, just reach out to us.
I think we had one last question here.
So I found that I want to figure out how high the value is. So if you take out everything you want away, and things are very hard to find the VC at every moment, how much of the those funds are available to combine VC with all to deploy in the new startups?
So the good news is Q1 was substantially better than Q4 of 2022 with 44 billion deployed, but it's still substantially down from before. And Ben, do you want to add to that?
I was just say follow Peter Walker from Carta to get like the most up to date, pretty